Hello and welcome to today's iXMB session on LICW Insurance Specialist multiple choice questions. I'm Swati and in this video we'll tackle 7 diverse questions mapped to key ICs. We'll walk through each problem, link it to the relevant IC code and demystify the solutions step by step. So let's get started. The agenda is mapping MCQs to different ICs, especially IC 85, 86 and IC 92, which are most relevant to the LICW insurance specialist exam. We'll consider a few examples across reinsurance, product pricing and risk management. And then we'll see through a fully integrated case combining quota share and excess of loss and reinsurance. Let's start with the first question, which is a calculation and case based actuarial question. And it is based upon IC 92. So a life insurer uses select mortality rates with Q30 at 0.002, Q30 plus 1 at 0.0025 and Q31 at 003. For 1000 lives aged 30, calculate the expected deaths in the second policy year. So how we'll approach this question? First, calculate the survivors after year 1 using the mortality rate for age 30. So here's the formula. Expected death in the year N is the number of survivors at the start of the year N and rate of X plus N minus 1, where X is the initial age and N is the policy year. So we see that after the first year, the survivors are 998. And then we calculate the number of deaths in the second year using the select rate applicable for the second year, which is Q30 plus 1. So 998 into 0.0025, which gives us approximately 2.485, which is the answer to this question. Next, we move to the second question, which is regulatory and market application based question, which is taken from IC 14, Regulation of Insurance Business. In the IRDA's 2024 consolidation, there were 37 legacy regulations which were merged into a new framework. This streamlining aims to reduce complexity and enhance compliance efficiency. Question 3, which is product and pricing applied professional knowledge question. It is taken from IC 46 and IC 92. So the question states that a participating policy has sum insured of 5 lakhs. With premiums paid 2 lakhs over 8 years, reserves 2.5 lakh and bonus of 80,000. If the surrender charges are 2% after 5 years, calculate surrender value. So first we will take across the formula of surrender value, which is surrender value is equal to reserves plus bonus minus the charges. So as you can see, the reserves is 2.5 lakh and the bonus is 80,000. So we will do a subtraction of charges from this, which is 2% of 2.5 lakhs, which sums out to be 3.32 lakhs, which is the answer to this question. Here you can also see some explanation that I've given across in this presentation. Similar way, all these explanations are provided in detail in our crisp notes that are done across all the units. Next, we move to question number 4, which is reinsurance and applied conceptual question. IC 85 and IC 92. A surplus treaty has 4 lines of 25 lakhs each. Now policies of 80 lakh, 1.2 crore and 40 lakhs are written. Calculate the total retention and cession amounts. So we know that one line is of 25 lakhs. So the 4 line would give us a maximum cession per risk of 1 crore. For each policy, retention is up to 25 lakh and rest up to 1 crore can be ceded. So policy wise calculation has to be done in this question. For policy 1, we see that 80 lakh is the sum insured. So first 25 lakhs would be retention and next 55 lakhs, which is 80 lakhs minus 25 lakhs, would be the cession. Policy number 2, which is 1.2 crore or 120 lakhs, We retain the first 25 lakhs, and for the session, maximum session allowed is 1 crore. So even though excess is 95 lakh, which can we can cede only up to 1 crore. So over and above 1 crore, 20 lakhs must be retained by the insurer. Policy number 3 of 40 lakhs. Here the retention would be 25 lakhs and the cession would be 15 lakhs. Moving across to fifth question, which is reinsurance and product pricing integration. IC 85 and IC 92 application. An insurance company is launching a new life insurance product with the sum insured ranging from 50 lakhs to 5 crores. The company has 6-line surplus treaty with a retention of 25 lakhs per life. For actuarial pricing, what percentage of premium should be allocated for reinsurance costs? If the average policy size is 1.5 crore and the reinsurance commission is 30%. So we see here that average sum insured is 150 lakhs and retention per life is 25 lakhs. So the retention ratio would be 25 upon 150, which sums out to be 16.67%. Hence option C is the correct answer to this question. Question number 6 is a complex product risk transfer question. And here there is a mixed application of IC 85, IC 86 and IC 92. A life insurer is developing a variable annuity product with guaranteed minimum death benefits. The insurer plans to use a combination of surplus reinsurance with a retention of 1 crore and a catastrophic XL cover of 10 crore excess of 2 crores aggregate. From a risk management perspective, what is the primary concern for actuarial assumption? So I've given the explanation here, which states that variable annuities with guaranteed expose the insurer to multiple interconnected risks. For robust actuarial modeling, it is crucial to consider not only mortality assumption but also investment volatility and policyholder behavior. These factors interact and can significantly affect the insurer's liability. Hence, the answer to this question would be integrated mortality, investment volatility, and policyholder behavior assumption. We move now to the last question in this presentation, risk transfer and management decision. This is also an integrated application question from IC 85 and IC 86. So a life insurer plans a quota share reinsurance for its growing group term portfolio plus XL cover. Which steps best integrate reinsurance strategy with enterprise risk management? So the answer to this question is B, which is evaluate claims volatility, retention levels, and counterparty risk. Best practice combines strategy treaty design with enterprise-wide risk controls. By assessing claims variability, optimal retention, and reinsurance strength, insurers align cost, risk appetite, and solvency objectives. That concludes our 7 MCQs aligned with insurance circulars. Keep practicing these integrated scenarios to sharpen both your computational skills and strategic mindset. For more resources, visit iXMB or email at hello@ixmb.com. Best of luck for your LIC EE exam. See you next time.